Hello all and welcome to our quarterly investment update with a fixed income focus. During the first 2 months of 2023, we saw US inflation prints that surprised first to the downside and then to the upside, with risk markets following in a whipsaw fashion. This was followed by a number of bank failures in the US and Europe during the month of March. Therefore, the actions of central banks were once again front and center in driving global risk sentiment and asset price swings for the year to date. The market reacts positively when inflation surprises to the downside, because this would mean less need to hike for the central banks. This time, however, it was not only monetary policy or central bank policy rates that were relevant, but also the role that central banks play to ensure the stable functioning of the financial system in general. For many investors, these banking episodes brought back bitter memories of the global financial crisis. Thankfully, fears of widespread contagion where the failure of one bank spills over into other banks or other countries were misplaced. Banks failed due to poor asset liability management and inadequate capitalization, as opposed to toxic elements that were lurking in the broader banking system. Central banks and other government authorities stepped in with swift, decisive action to help provide liquidity and restore confidence in the system. All the while, they kept a very firm emphasis on their determination to bring inflation under control, which was backed up by rate hikes in the US, Europe, England, and locally by the South African Reserve Bank. Global market participants are continually adjusting for changes in the factors that drive interest rates and economic activity. This affects their willingness to hold risky assets such as South African bonds. With the amount of uncertainty abound, long duration bonds here and abroad have seen very high levels of volatility. Our systematic investment models are in essence a way to assimilate all the relevant data series that we can find and condense it into tradable signals and portfolio solutions. Ultimately, the factors that we look at have been chosen based on their predictive efficacy for future bond returns. The metrics that we monitor have continued to indicate favorable valuation levels and conversely unfavorable financial conditions, while economics have been quite muted. Sentiment has moved around rapidly in light of the volatility experienced across currencies. On balance, our bond stance is moderately positive, and thus we hold measured levels of active duration risk relative to the benchmark. Many central banks, including the Fed, are recognizing that the need to tighten policy rates could be reaching an end soon. In the US, the labor market is showing signs of easing, with reductions in temporary workers, length of work week, and hourly wages being leading indicators of what we could expect for the more formal full-time employment numbers. This should go hand in hand with easing inflation in the medium term. Regarding monetary policy, the Fed will be on the lookout for signs of a slowdown in economic activity caused by the recent bank failures, which led to what we can call a credit crunch. As depositors heard about stress in the banking sector, they withdrew their funds, especially from smaller banks, which meant that these banks now had less capital on hand with which to extend loans to individuals and companies. Thus, their propensity to lend decreases. And this is exactly what monetary policy aims to do to a large extent. Therefore, these banking episodes could actually have done the work of a few rate hikes and might bring to a close the need to hike any more in the coming months. Market participants will be watching the relevant data prints very closely to see whether this is the case and to gauge the health of the economy amidst all these moving parts. Our systematic approach allows us to monitor all the data on offer and gauge which assets stand to benefit most from the current environment, allowing us to construct optimal portfolios free from emotional bias for our clients.